All right, good evening, ladies and gentlemen. Welcome to episode 7 now of the Australian Gold Weekly Review. We are now joined by our managing partner at the Australian Gold Fund and Gold Hub Australia, Mr. Brian Chu. How are you, Mr. Brian?
Hi, Ved. I'm glad to be here. Well done on manning the fort last week while I was away. I was just quite overwhelmed with my trip to Perth, and this time I'm still away from home on the border of New South Wales and Melbourne, New South Wales and Victoria. So glad to be back, and I think there's plenty of things happening. So looking forward to chat about it.
Absolutely, and I think we all felt the weight of your absence last week. Because if you notice, our last video did not manage to get the attention that it does when you featured alongside me for the video. So quite clearly, we know who the audience wants, and we are really happy to have you back for episode number 7. And that being said, if this is your first time watching, welcome to the series. This is a series where we uncover insights into the precious metals and mining equities market in Australia, as well as the commodities in itself, which is gold, silver, and oil mainly. And we want you to treat this series as a joint project between us, which is, if you have any kind of feedback for us, which you think would help you enhance your viewing experience, as well as the viewing experience in general, we would like you to put that in the comments section below, and we will definitely take action to make sure that your feedback has been realized in the episodes coming forward. And we also want you to know that none of the content that we discuss in this video qualifies as financial advice, and that if you're looking for financial advice, we recommend that you seek a licensed expert. The purpose of this series is to educate and entertain you. Unfortunately, last week we were only able to educate and not entertain, but now that Mr. Brian is back, we can do both of them. And so without any further ado, let's get straight into the video. So
before you do, I do have to say something fair to my good friend Dan Tuffin from Cavalier Resources, because we don't want to take away the contribution he made to those who viewed this video. And I certainly hope that those who are keeping an eye on Cavalier Resources, that they would now have more useful information that can help them with their decisions on what to do with the shares, whether they hold in their portfolio or not. I think the number of views is probably also a reflection of the effort we need to make on just reaching out to people with our posts. So if anyone feels like contributing in the comments how they can spread this far and wide, happy to hear it. You can do this also besides giving advice, by actively sharing this video with people around you who care or may not care, but at least if they click on it, they spend a few minutes watching this, maybe we might change their mind.
Absolutely, I do agree with that, and I would like to reinforce that the comments that I made about Mr. Brian's absence last week, as well as the lack of entertainment value, is strictly limited to only my part of the episode, and not Mr. Daniel Tuffin at all whatsoever. We had an absolute blast shooting with him last week, and we really, really value the contribution that he's made, not only for yesterday's video, but also the videos that he shot with us in the past. And we do wish him, as well as Cavalier Resources, all the very best. And with that being said, let's get straight into the video and talk about gold. So, Mr. Brian, not quite the narrative that we expected this week for gold, or did we? Because we've been talking about the Federal Reserve cutting rates in the September 16-17 session by 25 basis points. We did mention that the probability of them cutting rates by 25 basis points is about 80%, above 80% ever since September began. And we've been saying that ever since probably the last 2 or 3 episodes. And it's not a secret detail that we've been unpacking, which the viewers aren't aware of, or, gold investors in general aren't aware of. We knew that was coming, and we also knew that in an event of a 25 basis point cut or any form of rate cut whatsoever, it's actually a conducive environment for gold to rally further. That is, move on further. But what we noticed this week is as soon as the Fed cut rates, we saw a huge surge in gold prices momentarily. It did reach the US dollar 3,700 mark almost. And then within 3 hours, we just saw huge selling pressure coming in from the market. And gold, before we even knew it, fell down to 3,650 US dollars. So, I wouldn't like to say that gold increased this week. Factually, yes, it's increased by 0.11% this week. But I think the narrative that we would like to focus a spotlight on is the fact that despite Fed cutting rates, we've seen gold not cross the 3,700 US dollar mark, but actually approach it. And within hours of Fed cutting rates, go way down below that to US dollars 3,650. So what exactly is going on here? Because what we expected to happen has not happened this week. We've seen quite the opposite happen. So what exactly is going on?
Okay, so this is a good way to frame the question, because I think with the typical market observer, they focus on largely immediate reactions by the market on certain pieces of news. I do have a very good friend of mine who messages me regularly to discuss about the performance of gold and gold stocks. And he almost always talks about it from a one-day horizon. I sometimes would get a message, "Oh, Brian, gold stocks have fallen 4% today. What should I do?" "Oh, Brian, wow, gold stocks did really well today. This stock went up by 10% today." And every single time my reply to this friend is, and I'm not going to mention his name because I think he would appreciate remaining anonymous for this. I say, look, focus on what's been happening for the past few weeks or few months, because the market will react emotionally in the short term, but they will look at the bigger picture and process things more rationally in the long term. Let's look at, for example, how gold's performed since the beginning of this year. So we've seen several key levels that gold and also silver, mind you, have breached this year. It first hit 3,000 US dollars an ounce around the end of February. That was a major milestone. And then it reached 3,200 within, I think, about a month or two since February. Now, that wasn't a key resistance point or anything, but it was just significant. Do you remember when it actually hit 3,500 US dollars an ounce?
I think it was in June. I think June or July.
It was actually last month.
Yeah, August. Yes.
Actually, no, not even last month. It actually happened in this month. We smashed through 3,400, 3,500, 3,600 in quick succession. We're on the 19th of September today. And silver, similarly, it broke above 30 US dollars an ounce, if I remember correctly, sometime last year in around May. And then for a while, it held that ground. And I said on several occasions, even into this year, that it would, if once silver breaks above 35, that should bring a lot of excitement from the general market into not gold, but gold stocks. Gold stocks are much more correlated to silver movements than they are to gold, and we've talked about that before. We'll if we need to, we'll cover it again later today if we need to. Silver broke above $35 in June, and then in quick succession, it broke to above 37, 38, 39, and it hit 40 US dollars an ounce again in September, and we're at $42.40. So just because the rate cut didn't lead to gold and silver rising further immediately after, we're only a day and a half since the rate cut was announced. I'm not worried about that. And furthermore, it doesn't break the narrative that the rate cuts expectation of more rate cuts are going to cause gold and silver to retreat. But let's have a look at what happens next week. I'm pretty confident that the levels that gold and silver are at the moment, the current conditions will probably keep it at around this level, if not higher.
Right. Okay. Thank you so much. Thank you so much for that, Mr. Brian. So, there's also going to be an angle of the market pricing in the style of the commentary of the Fed, right? Because what we've been seeing this week from all the major news agencies that we go through is the speech by Jerome Powell on the September 16-17 meeting was hawkish and not dovish. And the comments that he's been making, or that he had been making leading up to this point in time, were quite the opposite to the tone that was implied in the meeting on September 16-17. So there were a lot of investors pricing in perhaps a 50 basis points cut into gold as well as silver. And the fact that it did not happen on September 17th is a reason why we saw this slight retreat in gold prices. Is that the way you would put it? Despite the fact that I think it was because we had this chat privately yesterday. I wasn't able to believe what happened, because for me it was so clear that there was going to be a 25 basis point cut. For the past month, there was not a single moment where I thought that there's going to be a 50 basis point cut. So why would we attribute this retreat to lots of investors expecting a 50 basis points cut when it was quite clear that it's going to be 25 basis points?
Okay, so I think 2 weeks ago, we had this same conversation just as the Federal Reserve, one of the Federal Reserve governors, Lisa Cook, was caught with committing mortgage fraud. And that led to President Trump wanting to remove her from the Federal Reserve Board, except I think the U.S. Circuit of the Court of Appeals retained, held back President Trump's decision, and Lisa Cook was allowed to remain on the board for this meeting. But at the same time, the U.S. Senate confirmed Steve Mirren to join the board, so there was an additional member in the Federal Reserve Board. Now, as you pointed out, the chance of a 50%, 50 basis points or 0.5% rate cut was much lower than a 0.25% rate cut. And that was reflected by decision 11-1. Only Steve Mirren actually signaled that he would support. He actually voted for a 0.5 percentage point rate cut. Now, if you look at how gold performed since the beginning, since I would say mid-July, early August, when gold was at its recent lows since the de-escalation of tensions about a nuclear war breaking out in the Middle East, gold's up by about 10 to 12%. And in the space of 2.5, 3 months for gold to rise 10 to 12%, this is not a high risk asset. This is traditionally a safe haven asset. Clearly, you could argue that gold has been overbought. So for the market, perhaps one of the reasons that they purchase more gold is expectation that the economy is weaker than expected, and therefore the Federal Reserve would need to cut by more than the market indicates. But given that the market confirms that the Federal Open Market Committee decided to reduce rates only by 0.25%, and there were and in the press release as well as the press conference, Jerome Powell mentioned that he believes the economy continues to be weak, but not weak enough for them to cut that much. So the market part of the market went ahead of itself, and therefore they're pricing back gold in light of the Federal Reserve signaling they're not going to be as aggressive in cutting interest rates, at least for now, even though President Trump has made it very clear that Jerome is too late, Powell. He is just too late. The Federal Open Market Committee is too late in getting things done. I personally feel that the economy, it's a strange one in this case. My argument is, I believe President Trump wants a lower interest rate, not because the economy is weak, but it is to make the economy potentially grow faster when you have more liquidity. So there is a difference in the way the economist sitting around a table is seeing how to run an economy, and a businessman who's now holding the most powerful position in the world sees how they should be doing things to get the economy to run better. We're seeing a divergence in the philosophy between the ivory tower people versus people who are more pragmatic and have run real businesses, even if President Trump's philosophy clashes against what mainstream economists, financial pundits, and also certain people in the business community believe.
Right. Thank you so much for that, Mr. Brian. That was quite comprehensive, in my opinion. And I think the viewers will now be able to have a clear understanding of why exactly this retreat happened, despite clear probabilities, established weeks ago about what was to happen at the Fed meeting on September 16, 17. So moving on to oil now, given that silver's pretty much followed suit with gold. One of the key supports for oil prices this week, which has gone down by 1.21%. So one of the key drivers of that was supply expectations. We've seen a discipline in the supply projections by the OPEC in recent times, which is exactly the opposite of what we had been talking about probably 3 episodes or 4 episodes ago. But however, we've got supply risks coming in from the Middle East, which kept the traders wary of the potential tightness, especially as inventories in the US have shown signs of drawing down. But at the same time, concerns about hurricane season disruptions in the Gulf of Mexico has also been lingering in the background, which does add a mild risk premium to the oil prices. On the demand side, however, oil struggled to push higher. So we've got economic data out of China, which is one of the biggest crude oil importers, continue to point to uneven growth, which kept the worries about industrial demand alive. And in the US, refinery runs were steady but not spectacular, and gasoline demand indicators remained soft, which did cap the optimism about consumption. So we've got the OPEC coming in strong with the supply projections, which is the exact opposite of what they had been talking about many weeks, about 3 to 4 weeks ago. But nonetheless, we now see that the supply is good enough, but there are issues with demand. So that's a complete flip in narrative, which has led to a decrease in oil prices. So what are the comments that you have about this, Mr. Brian, especially now considering that because of gold's rally and oil prices now, looking a bit bearish because of the flip in the narrative about supply and demand expectations. The gold oil ratio is up to 58 barrels an ounce. And so what do you think? What do you think about that?
Okay, so we have been talking every week, commenting briefly about oil and the context of the supply and demand the economic situation, how countries, key countries that import oil, consume oil, are performing, and that would affect the demand, and also OPEC's decisions to increase supply or decrease supply will affect the other end of the pricing equilibrium. What I find really interesting is it seems like we are in a period where the price of oil has been pretty stable between 60 to 65. I would call it the Goldilocks level. It's just right. So why may that be the case? I think the biggest factor is perhaps the U.S. economy is strengthening with the tariffs and the way manufacturing is getting back in line. But at the same time, so the demand from the U.S. is probably may have improved, and then the supply from the U.S. may also have started coming on board. That might be the case. And there is also a potential that the investment, the commodities exchange, the contracts that are being exchanged, because there is now more monitoring of potential manipulation of these contracts, these futures or forwards contracts that control the price. Perhaps there is a bit less manipulation, financial manipulation, and the physical trade of oil is determining the prices, and all these supply and demand equilibrium has led to oil trading at these ranges, which is conducive to keeping this global economy chugging along, despite conflicting observations as to whether it's an improving economy or whether it is a deteriorating economy as a whole, not just individual nations, but as a whole.
Right. Thank you so much. Thank you so much for that, Mr. Brian. And now, because we talked about the gold oil ratio being at 58 barrels an ounce, now we've seen things close to this level, I think, years ago when we had gold bull run happening post-COVID. At that point in time, the gold oil ratio was significantly higher.
You mean significantly lower after? So during the height of the pandemic, the gold to oil ratio went up to as much as 100 because oil went to absurdly low levels, and then as the world reopened, oil rallied from $40 to $120, and the gold to oil ratio fell from about 45 to as low as about 15.
Exactly. So the period that I'm talking about was the period when the oil prices crashed down during COVID and went to even negative levels, if I remember correctly. After that phase, I think this is the second strongest phase for the gold oil ratio. And that means a lot of things for gold producers, especially considering that the prices of gold are sort of rallying right now. And the prices of oil, as you said, are remaining in the right range, the $60 to $65 range. And we've seen the gold oil ratio not as high as it is right now for quite a while. Despite that, the ASX All Ordinaries Gold Index this week fell by 376.1 points. So I think in our 7 episodes, this is the first time that we've seen a fall in the ASX All Ordinaries Gold Index and not an increase. Is that right?
I think in these few episodes, there may have been during August, the first week of August, I think it actually fell. But then the subsequent weeks, they were actually rising. I remember there was actually one week where it ended lower than the previous week.
Right. But at least for the last 3 episodes, I believe, we've been seeing record increases in the ASX All Ordinaries Gold Index by We saw a 900-point increase about 2 weeks ago. We saw an 800-point increase last week. And we've seen, I think, in 2 episodes out of the 7, a 700-plus point increase as well. So for the index to fall down by 376.1 points this week is exactly mirroring the story of gold this week, in that it has retreated. And the reason why that's happened is on Monday, gold producers were singled out for profit-taking after weeks of outperformance. And the companies that we're talking about are Northern Star Resources, Evolution Mining, and Newmont Corporation, with Evolution Mining dropping as much as 7% within a single day. Northern Star Resources dropping as much as 3 to 4% in a single day. And producers like these carry a lot of index weights simply because of their size, their market cap, their valuation. So their slide mechanically dragged the whole basket lower. However, we've got the mid-tier companies bleeding too. Regis Resources, the company that was in focus for one of our episodes, down as well. Emerald Resources down, Capricorn Metals down, and Pantoro Gold as well down. And all of them, not by 1% or 2%, all of them are like down roughly between the 4 to 7% range. So we've seen a huge sell-off in gold producers this week, mid-tier as well as large. And besides that, we've just seen the index mirror the price movements in gold. However, by the end of the week, the gold stocks, I think, ended on a mixed note, not good, not bad. The largest producers ended the week slightly lower than last week, just as we mentioned, while a few explorers and developers such as Falcon Metals, Felix Gold, and Rox Resources rallied as investors started to pay attention to them. And despite the sell-off, despite falling down by 380 points almost, the gold stocks valuation index, which is a special index prepared by Gold Hub Australia, still claims that gold producers are in the overvalued region. And we haven't seen these levels for quite a while, because according to our index, anything above the 75% range deems gold producers as overvalued. And they're currently sitting at about 83%, which is significantly overvalued, at least considering the last 2 years. I don't think we've reached this level of overvaluation in the last few years, at least according to the ASX Gold Stocks Valuation Index. So what are your comments on that, Mr. Brian? And what do we have coming up ahead for gold producers, especially large cap producers like Evolution Mining and Northern Star Resources?
Well, let me tell you guys a story about what's happened this week. I was driving down on the way from my home in the Southern Highlands to Melbourne, as I had a trip to the Factor Investment Research Office. Now, on the way, I occasionally stopped for a break. I checked the markets, and I messaged the team about this, about how some of these large producers were selling off by between 4 to 8% from the Friday close. And the index was also down quite significantly, even though at the same time, gold was trading at, I think, $3,650 an ounce. And silver was about $41, $42 an ounce or something like that. And I said that I pointed out that I'm taking some profits from some of the largest producers in the portfolio, as well as a few mid-tiers, because they were trading at pretty elevated levels. So I pointed that out to the team, and also to a couple of my friends. I just pointed out to them that's what I'm doing. I never told them what they should do. I also expected that the divergence of gold and gold stocks points to gold being weaker for the week, unless the Federal Reserve was going to shock the market with a 0.5% rate cut, which they didn't. So that actually did play out. And once that happened, interestingly enough, gold pulled back a little more than some of the gold stocks, although, of course, the index actually also retreated. But if you look at the smaller end of the gold stock space, some of these explorers and early stage developers staged a significant rally, especially the last 2 days. So you've mentioned that you mentioned a couple of companies that had jumped, including Felix Gold, Felix Gold, Rox Resources. These companies actually increased by 15 to 25% in a day, and that's pretty significant, especially for Falcon Metals and Felix Gold. If you look at their share price since July, they've also gone parabolic, just like a couple of companies that have done so, including Dateline Resources, Gorilla Gold, Medallion Metals, Black Cat Syndicate, Barton Gold Holdings, to name a few. What we're seeing is possibly what I have foreshadowed for several months, that those smart investors in this space are selling some of their biggest gold producers because they are quite generously valued, and shifting some of those profits into these smaller companies. We're just now moving down that hierarchy. I do expect that perhaps next week, or if not next week, by the end of this month, gold will probably rise above $3,700 an ounce. Silver might even be approaching $44, $45. And we might see gold producers, the ASX Gold Index, make new highs as the market digests the news of the economy and realize the rate cut cycle is on and there's more liquidity. So I believe this, at least for myself, the last 2 or 3 days, I have also increased some of my holdings in the Australian Gold Fund to some of these smaller companies, including Cavalier Resources, because I am quite positive about the company's progress, and I have written to my newsletter readers in the past 2 months about my views, and also I recommended that they increase their holdings. So this drop doesn't really leave me flat-footed. In fact, this week's retreat, these gold stocks retreating, confirmed the things that I have talked about on record, whether it's in AUSBIZ, in my Factor Research newsletters, or in these weekly episodes. It's just playing out, but for most cases, we are actually buying the dip rather than fearing that the gold bull market has ended.
Right. Thank you so much for that, Mr. Brian. And let's just remind the viewers that none of the content discussed in this video qualifies as financial advice. There was a lot of discussion which we just had talking about the positions that Mr. Brian has taken as a part of the Australian Gold Fund and the outlook that he's got for gold as well coming into the future. And therefore, we'd like to let you know that it does not qualify as financial advice, and we recommend that you seek a licensed expert if you're on the outlook for the same. And with that, however, let's move on to the gold producer in focus this week. Mr. Brian just mentioned how explorers have gone up by 20 to 25% in a single day. We've talked about how much gold has moved up in the last few years. We've talked about many of the price increases, and I think it's about time we welcome this company into that group as well, and that is Catalyst Metals. Catalyst Metals is perhaps the best performing gold producer in the last 2 years. In September 2023, Catalyst Metals shares traded at 47 cents. and today it has closed at $8.04. The company hasn't undergone a share consolidation of any kind, and the 1,600% gain, therefore, is absolutely genuine. 1,600% in 2 years. And over these 2 years, it's transformed from a $100 million junior producer that was starting to generate positive operating cash flows from their Henty gold mine, which they've sold, by the way, if I'm correct, to a $2 billion plus mid-tier producer with further growth potential. In the most recent financial year, they've produced 108,000 ounces of gold at an all-in sustaining cost of 2,495 Australian dollars, with their plutonic mine contributing 86,000 ounces at 2,317 Australian dollars an ounce. So they've got quite a healthy operating margin, considering that their average realized price for gold is 4,238 Australian dollars. And that did manifest into their financials this week, as their revenue rose 43% to 453 million Australian dollars. EBITDA jumped to 193 million Australian dollars, and the NPAT reached 119 million Australian dollars. And all these are increases in percentage terms. All these are increases in the triple digits, by the way. They've got an operating cash flow after capital and corporate costs of 196 million Australian dollars. And the balance sheet finished with 230 million Australian dollars of cash and bullion, no debt, and an undrawn 100 million Australian dollars facility secured in July, giving them 330 million Australian dollars of liquidity to fund growth. That, in my opinion, is the clearest proof that the operations of this company are working. And a big part of the simplify and strengthen plan that Catalyst Metals has gone by this year was a portfolio cleanup and belt consolidation. And by that we mean that Catalyst sold their Henty mine in May, recycling capital into Western Australia, and booked a gain on the sale as well. It also received a 19.9% stake in Kaiser Reef and a long-dated option linked to the Malden plant, which is a useful low-cost optionality to add to their Victorian pipeline. And on the ground, Plutonic stayed on plan and free cash funded the real work. In the June quarter alone, the group production was 27,300 ounces, and cash generated after sustaining capital was 42 million Australian dollars, which was reinvested back into power station upgrades, camp expansions, and mine developments, along with an additional 21 million Australian dollars spent on growth and exploration. So this is exactly the pattern that we want to see. We've got stable quarterly results, and then we've got reinvestment happening back into the belt. And we've also got a lot of strategic decisions by the company in terms of, selling certain mines like the Henty mine and acquiring options to expand into Western Australia as well as Victoria. The group also cited 3.5 million ounces in mineral resources, which is an year-on-year increase. This has been the story for the company for the last 2 years, where the mineral resources have been increasing by significant levels. And the standout, though, was Trident, the Trident mine, after a rapid 6-month drill program. Trident's underground resource was updated to 795,000 ounces at 5.3 grams per ton, including 527,000 ounces of those resources at 6.4 grams per ton in the indicated category, which materially improved the near-term mine planning confidence as well. And this is one of the major, catalysts for the company's astounding rally, as investors expect Trident to deliver significant returns when it begins to produce. So, Mr. Brian, this is the story for Catalyst Metals, right? In the last 2 years, we've got stable quarterly results. We've got a significant increase in resources and reserves over the past couple of years. We've got strategic acquisitions of options to acquire mines, not only in Western Australia, but also in Victoria. We've also had strategic sell-offs of mines, which is the Henty mine, which was quite a significant mine to the company in the last couple of years as well. And with all that happening, we've got a steady producing mine in the background, which is the Plutonic belt. And we've also potentially got the Trident mine ready to go into production with really, really promising resource estimates. 1,600% in 2 years. So I think this is the NVIDIA of the precious metals and mining sector. What do you have to say about the company going forward? And what are the prospects for them?
Yep. So I was actually very lucky to have caught Catalyst Metals near its bottom 2 years, around the same time, 2 years ago, around the same time today. And I bought some at around 60 cents or so. I didn't buy a large parcel. Had I enjoyed the benefit of hindsight, I would have definitely bought much more. And also would have sold, taken some profits on the way up much less frequently than I should. What was instrumental in the company's success was its ability to make the right purchases of mine assets while gold was in a bear market. So, as you mentioned, it purchased the Henty gold mine in 2021 and started producing a very modest amount of gold, and it was kind of breaking even from a cash flow basis each quarter. Occasionally, it was actually going backwards. Now, the company was not very interesting to me for much of 2021 to 2023. It attracted my interest when it purchased Van Gogh Mining, which owned the Mary Mere deposit, which I think had about 1 million ounces of gold resources out in Western Australia, not far from Plutonic. In fact, I think Mary Mere is actually part of the Plutonic like the what they call the standalone operation. What really got me interested was when Catalyst Metals purchased Superior Gold. It merged with the company and therefore owned the Plutonic mine, and that was in about mid-2023. The Plutonic mine was once owned by, if I remember correctly, Barrick Gold, and they sold it to Northern Star Resources in 2015. Northern Star, I think, mined that for about 2 to 3 years. It was a high-cost mine, even though it was an underground mine. Somehow, at that current price of gold of about $1,500 to $1,700 Australian dollars an ounce, it wasn't that profitable. So Northern Star sold it to Superior Gold, and then Superior Gold eventually merged with Catalyst Metals. That was when I realized Catalyst Metals was on the path to significant. It was going to be a major transformation for the company, and that's what happened in the past 18 months. The company's share price increased from 47 cents to as high as, I think, $8.40 or so earlier this week. Now, I wouldn't go and say that Catalyst Metals is an NVIDIA, given the whopping returns that NVIDIA delivered in the past 3 years. But from ASX listed producers, you could probably argue that it was the ASX producers NVIDIA in the last 2.5 years. Now, going forward, I do want to point out that the share price of $8, I think something like $8.20, $8.04, I think something like that today, implies a market value of the company is over $2 billion. Catalyst Metals is expected to produce, I think, about 100,000 to 120,000 ounces of gold for the 2026 financial year, and the production would potentially be close to 200,000 ounces a year from 2027 onwards, if I remember correctly. It could be 2027 or 2028. that would justify at these current levels a market cap of perhaps $3 to $3.5 billion. So market cap currently is $2 billion. And when it produces 200,000 ounces of gold, I would say reasonably, the price tag would be 3.5 to 4 billion. So there is still another potential 70% increase, not including the potential for dilution. And if the company decides to take on some debt to multiply its potential gains, then those gains could be higher. What I am most interested in is at what point the company is going to restart the other mill, because the Plutonic has two processing plants. It has a 1.8 million ton per annum processing plant and a 1.2 million ton per annum processing plant. I think the 1.2 million ton per annum processing plant is the one that is in care and maintenance, owing to the fact that the company hasn't developed enough of the existing deposits on the property in Plutonic to run both mills to process all the ore. So Trident, as we've mentioned, is, I think, what boosted the company's share price from about $5 a share around the middle of this year to currently $8, because that deposit grew very quickly. There was successful exploration and the resources grew to just under 800,000 ounces, and the grades are over 5 grams per ton. That's high grade. So that could generate significant operating margins when it actually comes to production, and I think the market is pricing in that already. As for myself, I have been selling Catalyst Metals from about, I think, $1.80 all the way up to as high as $8.32. Right now, I am not in the mood to buy. I am waiting for the share price to perhaps fall back to about $6 to $7 range. Perhaps then I might top up. In fact, I did catch Catalyst Metals in the June to August retreat when it fell back from just about $8 to about $4.70, $4.80. I actually bought a little early, and I always do that. I bought on the way down at about $5.50 to $5.70 and watched it go all the way down to about $4.70, and I thought, darn. I didn't buy any when it was below $5. But I think buying at $5.70 and watching it trade at $8 makes me feel pretty smart. So I got part of it right. But because nowadays you have junior producers like Catalyst Metals, Ora Banda Mining, Pantoro Gold, these companies are all producing about 100 to 120,000 ounces of gold a year, and they're trading at $2 billion. I think even though the gold to ore ratio is 58, it's very, very profitable. I think the market is definitely pricing these companies to perfection, if not more. There is possibility that the gold to ore ratio could go up to 60 to 65. And that might justify these companies trading at even higher levels. But I believe there's still unprecedented times. And therefore, I am inclined to be cautious about piling into a company that has gone parabolic long after it's gone parabolic. It doesn't mean these companies are not good companies, but I would prefer to buy these companies at a better price level. And a gold bull market does not last forever, just like any other cyclical market.
Right. Thank you so much for that insight. Thank you so much for that insight, Mr. Brian. And this is a pattern that we've been seeing for these mid-tier producers in recent times, where they've been producing between 100 to 150,000 ounces of gold per year, or are projected to do that next year or in the next couple of years. And we've seen them trading at valuations of $2 billion and above. So in terms of that, there's definitely a bit of overbuying going on, as you suggested, and it is better that we wait for these prices to retreat slightly before we continue to further enter a long position for these stocks. But that, I believe, is a discussion for another video, as we've reached the 50-minute mark. Thank you so much, everyone, for watching. That was it for today. And we would like to remind you one more time that none of the content discussed in this video qualifies as financial advice. As much as I would have liked to mirror what Mr. Brian has been doing with some of these stocks and gold in the past few years, I'm only 22 years old, so my investing journey has only begun. But nonetheless, none of the content qualifies as financial advice. And we hope you keep that in mind. If you have any feedback for us, please put that in the comment section below. We definitely reply to any and every comment that comes up onto these videos, except for the crypto bros talking about crypto prices going up. And that's about it from my end. So thank you so much, everyone, for watching, and we'll see you next week.
All right. Thanks, everyone. And do enjoy the weekend. Take care and God bless.